All right. Welcome, friends, to the 14th or 15th or whatever during Planet and Friends
Yeah. Yeah.
event. We're really excited to have Lisa and Tim with us today. If you are joining, please make sure that your video is off and you are on mute. Um,
You want us off, do you?
Video and audio off, please, unless you are a speaker. Thank you. Okay, so I'm going to say a few opening words, both about the series, but also about this specific event today, and then we'll jump into little introductions here with the folks you have on screen. So the Enduring Planet and Friends series is all about arming climate entrepreneurs with the financial tools they need to be successful. We cover lots of topics, everything from the cost of debt to navigating bridge rounds to, whatever sort of topic du jour folks request. All of the sessions are meant to be tactical and actionable. This is not about like the state of the market. It's more about what do you do given the state of the market. And that means that these sessions are most successful when our participants are very active. So the chat is open to all of you. Please make sure you are kind of like you can drop comments in as we go. We will either respond to them in the chat or add them into our flow as we sort of have the dialogue. So don't be shy, ask the hard questions, and we'll make sure to get to them. This session is really about how to run a raise with speed, clarity, and conviction with really good process. We are kind of in a very new world in many ways, and fundraising is probably harder than ever. And so we want to make sure that folks have the tools they need to be successful. In our minds, most founders fail at fundraising because of bad process and bad storytelling. And so we're going to try to give you some actionable insights today on those fronts. Um, and so, without further ado, let's do quick intros. So I'll start because I'm already talking. My name is Dimitry. I'm the co-founder and CEO of Enduring Planet. We do two things for climate entrepreneurs. We are a lender, so we provide working capital to climate companies that have creditworthy contracts, either with government or commercial buyers. And then we also provide fractional financial services to climate companies. So accounting, modeling, dashboards, FP&A, kind of full suite of back office FinOps. We do it. We have over 70 clients now and growing. And we put on this thing. Oh, and maybe before I forget, this series is sponsored by Wilson Sonsini. They're great. If you guys need some lawyers, you should talk to them. That's not legal advice, nor am I making a formal referral, uh, whatever the other legal stuff I have to say. Okay, without further ado, Hannah, you want to quickly introduce yourself, and then we'll get Lisa and Tim to go.
Happily. It's been almost 1.5 years of teaming up with Dimitri. I wear a couple hats, but today I'm primarily wearing a venture capital hat. I am a venture partner with Planeteer Capital, which is a 54 million pre-seed and seed climate tech fund that we raised from scratch. So I have capital E empathy for all of the founders who've been in the fundraising processes, as well as having invested in over a dozen companies across 4 different continents, and looked at the good, the bad, and the ugly of pitch decks and fundraising processes from the investor's chair. In my free time, actually my day to day, I get to partner up with Dimitri. I wear the fractional CFO hat over at Lupine Finance, where I serve half a dozen hard tech industrial companies as they scale up their next generation infrastructure projects. So with that, it's such a privilege to welcome Lisa and Tim today. They are such powerhouses. So Lisa, we'll kick off with you.
Wonderful. Well, good to be here. So I'm Lisa Dyson. I'm one of the founders of AirProtein, where we make protein from air. And that's based on NASA research, where how do you make food where you don't have acres and acres of farmland. So I've been a part of fundraising across price rounds, across safe notes, convertible notes, what have you, over 100 million total, and happy to be a part of the conversation.
Yeah.
Awesome. Yeah, my name's Tim Thomson, the CFO at Charm Industrial for the last several years. Charm, to, I guess, summarize it, we take biomass from forest fire fuel load reduction and agricultural waste. We cook it into what looks like a barbecue sauce in a charcoal. And then we inject the barbecue sauce underground to fix orphaned oil wells, as well as to receive carbon credits there, and then add the char as a soil amendment for agricultural fields. Prior to that, I've been in a number of different climate startups, so everything from vertical agriculture to plant-based meats with Impossible Foods and earlier stage startups. I got started in the startup world with Stripe. And before all of that, I actually was on the investor side of the table, doing data center and telecom buyouts before they were nearly as trendy as they are now. But excited to share notes and answer some questions here.
I'm so excited to have both of you here. Well, and Hannah too, but Hannah's always here, so thank you guys. Why don't we start with just kind of defining what you both think truly like masterclass founder-led fundraising looks like, and let's keep these short. I just want like sort of punchy snippets, and then we'll dive into the meat. But maybe Lisa, you can start. Like, what does it mean to you? Share your thoughts.
Yeah, well, I guess when I say if a banker is leading it, then they have the relationships, they're making the connections, they're driving the pace, momentum, et cetera. And just as it sounds, the founder instead is the one, looking at the list of potential partners, investment partners, defining who we're going to talk to, the timeline, running the process.
Tim, what do you think?
Yeah, I think when people hear founder-led fundraising, the stuff that comes to mind is like the rounds that you hear about where people kind of snap their fingers and it comes together in a few weeks, and like those are the charismatic founders that kind of have that backing. But I usually tell people that it's more of a marathon than it is a sprint. I think the most successful fundraisers, the ones that do happen in weeks, are just the tip of the iceberg from like months or even years of managing folks up to that point. So happy to dive into that. But to me, it's really all of the groundwork that goes into prior to the fundraising. That's really where I think the founder can shine and be spending a lot of time.
I could not agree more. And I think this is actually, it's a good kind of segue into reflecting on the current moment. And Tim, maybe you can kick us off here. So I mentioned this in the intro, but fundraising today is very different than fundraising 5 years ago. And if there are folks in the room who raised around in like 2020, 2021, and then have since tried to raise capital, you felt this pain intimately. So Tim, like, I'm less interested in like the state of the world and more about like how has the mindset have to has had to shift given the new reality for folks who are raising. What kind of outdated fundraising instincts have you had to get rid of because they no longer apply?
Yeah, I would say there's two or three kind of relatively quick hitters. I think one, like 4 to 5 years ago, the market was very tilted to founders. And so like the instinct was to play hard to get and aggressively like push up valuations to minimize dilution. I call this there's always money in the banana stand like era of time. I know other people call it the zero interest period and everything else. But I think a lot of companies got burned by overstretching valuations and bake-offs so that like when the market actually turned down, there was a target on their back for those aggressive down rounds. And so the investor like startup relationship in my mind is more of a partnership, like thinking through like how you'll get to the next round, how you'll justify the next valuation should always take priority versus just minimizing dilution at like a singular instance in time. And I think that's like a new mentality that people have had to kind of acutely deal with now, whereas it wasn't always the case. And then like I said, I think the other piece is like um, the difference is you're always fundraising. Back to the marathon comment. I think at the time you could say, okay, it's gonna be 6 months and like it'll be done, and that's how it'll go. Like in my mind now, like you're leaving a sizable period of time. I'm often doing like pre-marketing too, where it's like you're like haven't entered the market yet, but you're talking to investors like you're about to enter the market where you can do a lot of discovery. And I often tell people, which is counterintuitive sometimes, when you're in the fundraising mode, it's often helpful to talk to people up and down the entire capital stack, even if you know they're not going to participate in the round, which I think is different too, where like you might be raising an A, but I would recommend bringing in a few growth people that might stretch down. They probably won't, but what you're actually doing is showing them like, what are you saying you're going to hit, kind of bringing them along the journey so that when you come up to the next round, they're actually ready and you've got sort of a normalized cadence. And that's what I mean by how this is like a constant ongoing thing versus like a snapshot in time.
Well, and I think one thing too that people don't often expect is if they talk to later stage investors so like to your example, let's say you're raising an A and you're talking to people who invested B and C, they're going to tell you what they're going to want to see at B and C. And then that helps you shape your narrative for the people you're talking to about your A. And you can be like, these are the metrics. And now you have validated metrics to point to and say, hey, I know that when we hit these, and hopefully the market doesn't shift again, because it sometimes does, right? Like as an example, we've had a fintech investor who every single year, they're like, hey, if you want to do an A with us, here are the metrics you'll need. And in the last 3 years, those metrics have changed every single year to become higher and higher. So like, don't fall into that trap, but it does happen. Okay. And I think also this point about sort of like 6 months, I think that people just need to take whatever dogma they had about the timeline and the number of investors they need to talk to and just throw that shit out the window. Because in our experience, we've seen founders raise around in 3 months with 50 conversations, but also in 2 years with 400 conversations. And like for most people, you're likely to be on the harder side of that spectrum than you are on the like easier side of that spectrum. Hannah, what are some of the dangerous stories you're seeing folks tell themselves in the current fundraising environment that you feel like are, pernicious?
Yeah, it's hilarious actually how much my answers reflect some of Tim's comments right there. I've seen founders like say, well, we're worth this much. Like we're worth a $50 million valuation. We're really not going to talk to anyone who's thinking about things less. It's like, no, I think that's a really dangerous internal story to maintain. That might be a target, it might be the goal, it might be plan A, but you're worth what the market says you are worth. And there's a lot of great ways to build businesses. Our next event is actually going to be on down rounds, we hope. And so, there's a lot of great ways to continue to pivot or de-risk the things that you need to in order to unlock downstream waves of infrastructure capital or the like, even if that doesn't look as pretty or it doesn't optimize for dilution the way that you would like it to. So like the most dangerous story you can tell yourself is that your valuation is overinflated. I think that the second one is, I talk to CEOs all day long and they'll be like, yeah, I'm spending 40% of my time on hiring, 45% of my time on commercial contracts. I'm spending 25% of my time on, 15% of my time on, managing the engineering teams, making sure that communication goes well. And they're like, yeah, and I do fundraising nights and weekends. It's like, no, fundraising is a real scope of work. And if you're not treating it like a real scope of work, or you don't have an amazing, like if it's not Lisa doing it or finding the right banker, or it's not Tim in the CFO seat managing that holistically, you can really let that just kind of run away. And I think if you don't run it like a real process and actually be pretty dogged about follow-ups and relationships and tracking your touch points and keeping lists of the people that you want to update with milestones and asks versus keeping lists of the updates you want to send to folks who you're actually approaching for different rounds. I think that's a huge miss, and I think it's a dangerous place to be when you are raising Series A, Bs, and Cs the same way that you raised your pre-seeds and seed on relationships only.
I want to pull in a question from the chat because I hear this a lot and I just want to respond to it. I would say that if you're raising anything below a Series B, or like if you're raising venture below a Series B, I would probably never use a banker. Most VCs feel very strongly about wanting to back companies where the founder can fundraise. And most of the VCs I know, they like won't even take intros from bankers for early rounds. That is different for companies where you're raising project finance or you have like a complicated finance structure where a banker might add validity and sort of validation. At later stages, people are expecting folks to start to engage bankers because it sort of makes sense, right? You're like, hey, like I have to run a business, go raise this money. But I would not. I think Tim's right. Like there are advisors who can help you with guidance on how to raise, but in the end, like in some ways, fundraising is a test of your ability as a CEO because fundraising is like selling, it's like hiring. There's a lot of these parallels, and people are wanting to see, can you actually accomplish this? Can you market your business effectively? Um,
I would
yeah, go
just
ahead.
add, I would add that it's
yeah.
also like a test of your networking because it doesn't
Yeah.
necessarily need to be a formal advisor. I think sometimes formal advisors add credibility to it, but I've helped a lot of folks with their seed or early stage things kind of build the model, test, and like be the sounding board to like, essentially red team the conversations and prep them to do all of that stuff to get ready. And so it can be formal or informal on the advisor side, but it's really the ability, like, can I pull in all those pieces that pressure test the story with the right safe space before I go and enter the thing into the wild?
Yeah, and
Yeah.
one comment I'll add too with bankers, much like the comment of engaging later stage investors earlier, you can also engage bankers. They would want you to come to them in later rounds or what have you, and so they may be willing to make introductions. So we've definitely got investors directly from bankers who've made introductions for us. They can tell you what's going on in the market. They'll tell you what investors are looking for. They kind of have their finger on the pulse, as it were. So, and they're interested in engaging with startups that one day or earlier companies that one day would need their services.
Lisa, I want to turn to you because one of the things that is probably obvious to a lot of folks in the room is that in the current environment, there are certain things that are really hot and certain things that are not hot, right? Like it's basically like AI and everything else, right? And you have a business that is is probably for a lot of investors like kind of hard to like wrap their head around. It's not like your typical SaaS or AI startup, right? So how do you like navigate that process and how do you tell that story without getting trapped in like explaining yourself into a corner? Like how does that work for you? And what are some insights you can share with folks who might be raising money for things that aren't fitting that mold?
Yeah, good question. I will tell people we make protein from air and stop at that point in terms of the technical description of what we do and go to the value proposition. And for us, and this is a protein moment. You go to Starbucks and there's protein in your phone. Protein in pancakes, protein on popcorn, protein is everywhere. So I go directly to what the market is actually demanding and wanting right now. And then our customers are the companies that are making those products. And so what is it about our product and our value proposition that allows them to deliver what consumers are looking for? So it's getting to the business pretty quickly. And if the interest is there, if it's the right fit. So it's really important for founders to know not they'll just pitch to everyone. Not everyone's going to be the right type of investor for you. So it's screening first, but talking to investors that are looking for things in your space or adjacent or whether it's impact, whether it's food, whether it's in our case the few climate investors that are still out there, or just things that are disrupting supply chains. So knowing the profile of the portfolios of the companies that they're looking for, and then going right to the value proposition early. And if they're interested, they'll want to know the details, and we'll always get back to that.
I think I want to like maybe double down on this value prop comment and go one step further, which is that probably the biggest problem that I see in pitch decks and pitches from founders is that they anchor on this like concept of climate benefit, or they anchor on this sort of like, oh, transportation emissions are 97% of XYZ, and we have to fix this problem. And 99% of the investors you talk to won't care. Like they might say they care. They might be calling themselves a climate fund. They don't care. What they care about is, are you solving a problem for a customer that's going to pay you to solve that problem, because they already either spend a lot of money on solving the problem in a different way, or because that cost is borne in other ways, more time, more resources, whatever, right? And the founders that we see very successfully get to sort of interest with investors are the ones that say, hey, look, we solved this problem that, X number of people will spend Y amount of money to fix. And that means that the market is this big. And then people can be like, oh, you're saying like, Dyson Foods. Sorry, I just picked Dyson because your last name's Dyson, but like, oh, they want to buy protein at X amount of money, and they're interested in Y aspects, and we can solve that for them at a price point that's compelling, right? And like a lot of people don't do that up front, and I think that often will also speak to your ability as an operator to think to like show what actually matters to a business, which is in the end like revenue, right?
Absolutely, absolutely. They want to make sure that this is something that is going to get them a return. So it needs to be, you need to identify what the pain points are and how you have a competitive advantage, a unique advantage to solve those pain points for companies.
Okay, so let's shift towards process, because I think we've all talked a little bit about how like a tight process matters. And I think that a lot of folks who haven't raised before, they think of fundraising as like, okay, I'm going to just have conversations here and there with investors. I'll reach out to people I know. I'll have a few meetings, and like it'll come together. And that just isn't how fundraising works. And so, Lisa, walk us through how you structure your time during a raise. Like, what does your calendar look like? And like, how do you make sure that the company doesn't fall apart while you're focusing on fundraising? And maybe like also, just to set the scene, how much of your time are you actually allocating to fundraising when you're fundraising?
Well, two-part answer. So I've definitely been in the fundraising journey where, pretty much 90% of my time has been allocated to fundraising.
That works.
Yes. And it depends on where we are in the process as well. And an example is at the beginning of the day, like meeting with, finance lead and checking in on the process, where are we with different investors? What are we going to do? Who are we going to contact today? What meetings we're going to set up, what have you? And then carving out some dedicated time to doing different things that may need to be done for fundraising, an hour and a half, 2 hours, that's just blocked on the calendar. So this is just dedicated mental space for fundraising. And then, there's various meetings throughout the day, but making sure there's the time to check in with the team to make sure things are continuing to progress, having a really structured way of checking in with them, having our, Asana or whatever tool you're using to make sure everything's on track. And I think just making sure you have a system and you work the system. That's the important detail, is working the system, like just whatever the structure is, and continue to work that.
Okay, I'm like furiously typing the exact same thing in the chat to one of these questions, which is like, there are a bazillion systems out there, CRMs, really expensive, fancy, automated AI integrations with your calendar and your emails that can give you like a single record of a contact. You can use Excel, you can use the manual input of Airtable if you've got like a super diligent chief of staff who's like willing to catch every ball in there. Whatever you use, like use it religiously. Like you have to have one single source of truth and command center in these processes. I think one of the things I see a lot is like great, show me your investor CRM, and they're like, actually we don't have one, or here are the 4 sheets we were using last year, but all of them are out of date and half of it's buried in my inbox. That's like the worst place to be.
Tim, I want to shift to you because, one, Charm's a little further ahead, so your fundraising process looks a little different, but also you're the CFO and there's a CEO who also raises capital. So talk to us a little bit about that dynamic and how that interplay works in practice, and what are the things you've found to be really effective to manage that dynamic?
Yeah, I kind of think of the CFO as like the the person that can grease the wheels and make the round go faster. Like the way I see it, the CEO really builds the bench of potential investors, like establishes the network to activate at the time the raise is starting. It's really the person who sells the vision and kind of stokes the interest in the opportunity. And then the CFO is often building and managing all the scaffolding behind the scenes. So like pre-prepping the data room, ensuring the TEA ties to the financial model, like pulling together the proof points that like really build the confidence in the pathway. And I think just like helping develop the materials that really hold up in diligence, or what I would call like the more financial technical storytelling. So like put differently, the way I've seen it really work well is the CEO gets the people hooked on the idea that something will work. And then the CFO really shows them exactly how that's going to happen. So like in the most cases, we'll kind of co-pitch and listen together where the CEO will lead it. And then there'll be a handoff, and then we'll kind of bring in the CEO for relationship management and things like that going forward as we kind of continue to execute on the round.
I think one thing that I maybe just will throw out here is for teams where you have an internal or even fractional finance leader in the company, right? VP of finance, CFO, actual CFO, whatever. Don't make the mistake of having them do investor outreach. Don't do it. Even if you suck at email, even if you feel busy, you as the CEO, until probably at least Series B, need to be the first point of contact for an investor. Don't have your chief of staff ask for a meeting with investors. Don't do it. We've seen like, at least, I don't know, maybe Tim, your experience is different.
No, I would literally say this goes back to the earlier point on networking too, as like a prime thing. Like usually before we enter a fundraise, the way that I structure this is I think about who are our tier one, tier two, and tier three investors. Tier one being like, these are our dream leads that really set us up for success. Tier two, like we'll be okay with them, but like they're not necessarily the flashy names. Tier three, like they probably won't ever be able to lead, but could feasibly like fill in. Once we do that, we typically will approach the tier two groups first, and basically sharpen our message and really define what we're trying to say, and also get a pulse on the market through those. Because look, if one of them leaves, great, you've got a term sheet, you go, and you know what, there are worse things that happen on that side, and you can really run with it. And then I think like from there, what we actually do is we take the list and we say, all right, who's got the warmest in?
Uh-oh. Did we lose Tim?
I'm with you, Dimitri.
Okay, why don't we'll wait for Tim to come back. Hannah, let's talk a little bit about this, the sort of the target list, right? So how do founders actually build a target list that's useful, right? Like there's infinite freaking, here's 1,000 VCs that invest in climate. And it's like, that's a really, really hard place to start. So how do founders build a target list? And like, maybe what are some of your thoughts about the cost of going kind of too broad, too narrow? And maybe the last part of this that you can start to talk to, but then I want to also hear Lisa's perspective is like, okay, you built a target list, now what? Like, how do you actually get connected to all of those people? Because not all founders the same network, right?
Yeah. If any of my clients are in the audience, they're going to be laughing because we've been doing this repeatedly over the last few months. And I literally sent them an Excel file that I maintain, and I have combined multiple different sources of like, there's billions of lists out there, right? And they always change. So you're trying to kind of keep tabs on the market. I take that list of literally, I think it's like 3,000 names across like primary climate tech investors. And we then like winnow it down. So I ideally have them, you kind of tag them. If you are starting from scratch, I have to say this moment in time is more unique than ever before. Like previously, I think an exceptional chief of staff would actually just be running this like a special project of like a month or two in advance, like doing this type of desk research. However, AI is an incredible enabler in this. It definitely hallucinates. It does get this wrong, but for the winnowing process, it's incredibly helpful. And really, you don't want to have a true target list, this kind of tier 1, 2, and 3. I run the exact same process that Tim was describing. You really don't want that list to be more than, I'd say, like 300, 400 names to start. Like, you have to create, don't boil the ocean. And if you are doing that researching and winnowing process correctly, those 300, 400 names are on target for geography, they're on target for stage, they're on target for kind of sector focus for you. And approaching the tier 2s helps you get a real quick view. But lots of this stuff is published on folks' websites, and using some form of like targeted approaches for these investors is really helpful. So I think I can pass it back to Tim here, but in a lot of ways, like there are various executives at the company who may be connected, and going in cold while also getting your board members or investors to introduce you while potentially also getting a referral from one of their portfolio companies. You can imagine the multi-layered approach of getting in front of the right investors. And you can see how much research and networking goes into sending those distinct emails of, I'm reaching out cold to the GP. I'm also having my board member reach out to their partner so that it comes in another channel. And I'm sending a distinctly tailored note that actually looks more like advice than it does like fundraising to one of their portfolio founders that says like, hey, how have they been as an investor? If I were to approach them with this raise, have you seen them do deals like that in the past? And then ideally that portfolio founder says like, they're amazing, I'd love to introduce you, right? I'll take pause there in case Tim wants to fill in on any of his last comments after he described tier 1, 2, 3.
Yeah, I'm not sure where I cut off. Believe it or not, it looks like Comcast has cut internet to my house because I'm plugged in hardline on my computer and it's gone. So we will
What did
see.
you say, Tim?
I don't know. So we're going to do the Blair Witch Project version of this with me holding up the cell phone. I think I'm not sure where I cut off, but just to what Hannah basically said, like once we build that list of who we're going after, we basically say who's got the warmest intro, who if we don't have a warm intro, we'll tap our network of other founders, other access points, or any of those types of things that can basically get that in. And we will use the board and those types of members as well to basically figure out who's going to have the most receptive conversation. And if it's somebody that's relatively cold, we always lead with the founder just to make sure that messaging gets taken seriously.
I want to just chime in and Hannah, I'm going to maybe push back on something you said, and the team can, like, my sense is that cold outreach is successful in terms of connecting with investors like 1% of the time. And really like the name of the game is getting a warm referral. And there's like a tiered system, like founders in their portfolio, that's probably the best referral you can get. Co-investors is another good referral. Friends of the VC is a third. And like you also want to make sure that the person who's referring you into that VC has a good reputation. So like that's kind of my sense. Are you actually seeing cold outreach work? If it's written,
I'm a huge fan of cold outreach. I agree that everything you just described comes first and is way preferable. But like at the end of the day, like pick up the phone. At the end of the day, like do the cold outreach. I think the way you do cold outreach is very important. And I think I see VCs debating this all day long on LinkedIn. I try not to participate very much. I do cold outreach. Like you have to make that message high EQ, which is like, hey, I'm sure you get a lot of these, but I've really been following your work. I love the way you prioritize these segments. We might have something interesting and it looks like it could be in your stage. Happy to chat at your convenience. And you can send them a direct LinkedIn message. You'd be surprised by how many VCs on X, on LinkedIn, like really respond to those things. And I've gotten really solid introductions that way, or solid conversations, I'd say. You're starting from a back foot, right? So agree to disagree, Dimitri, and I'm with you. There's a whole priority list before doing cold outreach.
And one thing
Lisa,
that I'll
anything you want to add?
add,
Oh yeah, go ahead.
I'll add that just thinking about, well, what networks am I a part of? Many of you on this call, you have your networks, but some of you may be thinking, hey, I'm not well networked. I don't know what stage your company is and where you are as a founder. But to think about the universities you went to, your alumni networks as well. There's many alumni databases out there that allows you to see who worked where, just connecting with other founders. It could be a founder of a specific fund, but just founders in general are connected to other founders, and they could potentially get you the introduction to someone that is connected to those investors. It is one of the things that you're looking for when you do get investors and when you build your board and build your advisor network, is that you want to make sure that you have people that are connected and that can make those introductions. And this is where bankers could come in again. We've gotten many introductions from bankers. They're all well connected. They could look at your list. They know who they're connected to in that list that might be investing in your space and might be interested in a company like you. So tap into bankers for that reason as well.
Maybe like we could just take 2 minutes if everybody can do like a quick round robin. What is one element of good process in a fundraise that you think goes like unnoticed or is not talked about enough? Like what's one thing that you think is just makes the difference between a raise that's good and great that people don't often talk about? Tim, you want to start? Put you in the hot seat.
Mine is on the later stage of it, which is probably, this is a nod to Wilson Sonsini, I guess. I would say legal documents. I think sometimes it's like people too often defer on key terms here. And like this can go for term sheets as well as kind of thinking about things like liquidation preferences or other things, or even how the governance structure will actually look. Like it's not glamorous. I think it's a really hard position as a founder to be in, because oftentimes too, like investors and founders are trying to like be friends. And if you're a first time founder, like the investors will basically say like, oh, these things will never come into play. Like, these are just formalities that we have to go, and you don't know how hard you can kind of push. I think it's also expensive, and it's hard to negotiate in that position, but it's can be the difference between weathering a challenging stretch and still maintaining control of your company, and like it's also a big difference maker in what the next fundraise can look like because of how potentially hamstrung or what your optionality is. So I always tell people like it doesn't stop at the term sheet, and also take your time seriously at the term sheet and all of those things, because these things do matter.
I think also maybe I would add is like don't be shy asking for things to be codified in the term sheet that you are worried about. Like sometimes VCs will send you a term sheet that is actually incomplete because of lots of reasons. And they're like, and oftentimes you'll be like, well, what about this? And they're like, oh, we'll finalize that in the docs. No, the answer is no. Like, I want to see this in the term sheet. I want to align on the commercial terms now. And actually, I think like taking that posture can be really powerful, and it also signals to an investor that you're not messing around, that you're like a seasoned operator. Especially if it's something like really, really core and central, information rights, reporting, liquidation preferences, you know, who selects the board member that preferred stock actually gets as part of a raise. Like, I'll tell you, like we had this issue in our seed round. We had a term sheet. It was simple. We went into docs, and then we burnt probably like 2 weeks negotiating a thing that could have been done, and it worked out fine. We love our lead, but it took more time than it needed to. Lisa, do you have one?
Yeah, I guess what I would say is before you start the process, maybe lay out the milestones that you plan on accomplishing during that period, and then continuously update investors as you're hitting those milestones so that they both see that you're doing what you said you're going to do, or also just see that there's momentum, that there's progress, that things are happening and moving.
So you're not talking about like milestones for the raise. You're talking about milestones for the business that allow you to show that like the business is progressing while you're raising.
That's right. And the train is leaving. We'd love for them to be a part of the journey.
Yeah.
Mm-hmm.
That is such a pro tip, actually. And the other thing that I've worked on with a couple founders is like when you get to that point in the fundraising where, gosh, you've got like more soft circled interest from follow-ons and strategics, but no lead. And like you need that catalyst for the round to come together. And it feels like the timelines are slipping and slipping and slipping, and you just can't get anyone to have the same urgency. We've been basically coming up with a little cachet of bullet points of like the wins recently of like, hey, we got a term sheet to go negotiate this new contract with a customer, or hey, we got, honored at this prize or whatever. And like using that as a bank of little recent wins so that when you follow up with an investor who's been going cold on you or like quieter, you can say like, hey, we had a win, just checking in on your side, instead of like, hi, just following up, like how are things going? Can we connect again? You kind of like making them feel the FOMO. Um, I guess that ties to my, if I may jump in, Dimitri, my like process, the best part of the process. When my business partner and I, Sophie Purdom, raised Planeteer Capital, we used to have this like friendly competition about who could draft the email reply to the LP within the first 10 to 15 minutes of receipt. Like if you act like a founder with urgency about your fundraise, it really shows to all of your partners, and it helps create the drumbeat behind momentum, because as much as you want them to, your lead investors and the investors you're approaching, they will not hold that pace for you. Like you have to maintain it. And the like, I hate to say it, but like the 10 p.m. replies, the like 15-minute replies, the I saw this, I'll get back to you, I'm gonna wrangle whoever. It actually is a really indicative sign that you're like really on top of your process. Um,
I'm gonna super second that. Like as a lender, which is obviously very different, right? Like our credit process for a potential borrower is very different than a typical VC raise. But I will tell you that our credit team pays attention to how quickly you respond to requests, how much you follow up. And also, I mean, the flip side of this is like you have to balance it with seeming pushy or needy, right? So there's a difference between sending a follow-up and being like, hey, like Lisa said, we just rolled out this pilot with a new client and like things are progressing and we have two prospective leads taking us to IC next week. Let me know if you have any questions. That's a very different thing than reaching out and being like, hey, I need an update. Trying to raise money here. What's the word? Like those land very differently. Um, and actually, this is like a great segue. So let's talk a little bit about creating sort of, and I want to be careful with the language I use, right? There's manufacturing urgency and there's manufacturing urgency, right? Like, maybe to set the context here, fundraising from VCs, especially at earlier stages, is very much a vibes-driven process. It's a lot of emotional kind of like psychological games in ways that I personally find really frustrating. I think it's like it does a disservice to highly technical founders. It does a disservice to folks who just don't want to play mind games. But in the end, like it is what it is, right? And so in that context, one of the things that often creates the incentive for VCs to make faster decisions is if they feel like they're going to miss an opportunity. And this is what a lot of people talk about in terms of urgency. And this word has like come up a lot today. So I'm curious, and I think everybody can comment on this. Like, what are some of the tactics that you've used to create that momentum and urgency in a round? And I also will say next week we're going to publish an insight on this exact question on our blog. If people want to come back next week and read about it more, Sam Hasty from Active Impact is going to be commenting on that too. So, but I would love to hear from you guys. Maybe we'll start with Lisa, then Hannah, then Tim.
Yeah, I think that double clicking on kind of the prior question and the response there about when the business is moving, then that's an indication that, hey, we need to, we need to close this so we can, continue to move the business. We need to continue to go after this customer, close this deal. We just secured this regulatory approval. Now that unlocks XYZ, whatever it happens to be. So the real business motion can help drive the urgency is what I would say. If you frame it properly, here's why we need to close it by this time so that we can deliver for these customers. But also, I think just really actually having time frame, like setting aside a certain amount of time that you want to devote to this, and that being a real thing that you're driving towards, and pushing everyone to get there, and letting them know, how much of the round is soft circled, and then it takes various shapes as you go along, how many other investors are at the table looking to invest in this, and just being honest about that part of the process.
I have no notes for that. Perfect explanation.
Tim, anything you want to add?
Yeah, maybe I can describe how I think about it visually on timing and building the momentum. And I always tell this to people that I hire into startups for the first time and everything else. So I'm sure it will resonate with some folks, but I always describe the startup experience as like a sine curve. So if you're used to sort of that like up and down and up and down, and I always say if you zoom out and you look, it's generally going hopefully up and to the right. But like some days you feel like you're gonna be the next big thing. Some days you're like, I'm gonna go bankrupt. Um, as far as it goes to fundraise, right? Usually the recommendation is like I say, what are the must-hit milestones where we're kind of rising up to that crest? But I always try to advise not to get greedy, to be at the crest, like when you're trying to start that, because that's when, you find out like something inevitably will just go wrong and then cause pause on that side. And so basically we come up with a list of here's the must hit milestones. We're going to enter the market as we have these. Then we'll have the set of like, what are the 2 or 3 things that we think will hit during this time and where will that go? And then, so even as we go back to that pre-marketing stuff, we'll talk about that to some folks too in the pre-marketing. Like, hey, we're gonna probably fundraise when we're gonna hit this. We're gonna hit these things, and that way, when they say it, we can say we actually hit those things. Those things are going. And if those milestones that you're kind of hitting as you're raising up to that crest hit, you can really use that as the sense of urgency to say, look, it's validation on the valuation and all of those different things. Like you gave me that term sheet before this. Now the customer came in. I said the customer was going to come in, and there's that much more certainty to it. So like, let's just get this done where we're at and try to get the deal going forward as well. So that's kind of how I think about it and like time it. It's challenging, and this is another reason why I say it's a marathon, because we're literally looking at this 12 to 18 months in advance and basically looking throughout each quarter and saying, what are we going to have aggregated by now? What are we going to have aggregated there? And what will be near term before we kind of go and start that fundraising process?
And I think this also speaks to like the critical importance of sequencing and like organizing how your top of funnel moves down your fundraising process. Because one of the things that I've seen kind of like kill urgency the most in rounds is where people don't have a dedicated period for like first meetings, second meetings, trying to move to term sheet. Like, people have, I'll have 10 fundraising meetings a week for the next 6 months. That will not create urgency because you won't have enough people in the process digging in at the same time, kind of pushing each other, right? Like if you have 5 VCs taking you to IC to be a lead in the same 2-week period, the likelihood that one will write you a term sheet purely on the fact that there are 4 others interested is very high. If you have one person who's sort of thinking about the round, and the next time another person is going to sort of think about the round is 2 weeks from now, there's no urgency. There's no momentum. And sometimes you'll shoot your shot. You'll bulk up all your first meetings in a month, and you won't get the traction you want. And that's okay. That doesn't mean you should give up. It doesn't mean you should stop. Like, for reference, our seed round, which arguably wasn't super successful because we raised way less money than we wanted to, but it took 18 months. And we did it with safes and then price, and we brought some money in and we did some interim closes. Like we had lots of creative ways in which we navigated that. But to Tim's point, like it's a marathon, but you at least should have the initial intent to have a very tight timeline, which like creates that urgency for people. And this like is actually maybe a good segue, right? So what happens when you do hit that bump in the road in a raise, and the momentum you wanted to create it kind of peters out? Like, when do you know it's time to pause? When do you know it's time to reprice? When do you know that like maybe the raise won't happen and you need a contingency plan? Like, how do you sort of like read the tea leaves to make that decision? And maybe Hannah will start with you and then we'll go Tim and then Lisa.
Sure. All right. In answer to that question, I think that you you have to be willing. It's great to have an internal thought partner on this because you have to be willing to honestly reflect on what's resonating and what's not with investors. Like, are you getting a lot of, oh, this is like too early for us, like keep us updated as traction and the round comes together? Like that's a pretty lukewarm thing that investors say. It doesn't really mean much unless you felt like you got to fifth calls in diligence. They saw everything in the data room and they're like, no, genuinely, I'm very interested. You know that they're over allocated in seed right now and that they would look at the A when you come around to that. Like you have to gauge that based on the depth of the conversations you've had with those folks and be like stark honest internally about, is this stalling because our value proposition and our commercial angle isn't resonating in the market, or we don't have enough, like truly don't have enough traction, in which case assessing, do you need to pause the round, try to get more traction, make like operational changes in order to get to a further state? Is it, or did you kind of like not really comprehensively go after your target audience? You like followed a few folks down diligence, and because you didn't like try to coordinate all of those folks together at the same time to get another investor to kind of be taking you to IC so that you can apply that messaging to the rest of your investors, like maybe you do then want to go back to your CRM and open up more introductions because you have the runway to do that. Those are very different scenarios, and I think the hard reality is figuring out, what do you do operationally? How do you cut burn if you think you need to get to different milestones to attract investors? I see a lot of founders trying to play with round sizes based on momentum, and I think the challenge of that is really like how it affects your valuation in the process. Like, I think that if you downsize a round, that can be one thing, right? But you're then clipping your wings about what milestones you can reach ahead of the subsequent round. But if you're upsizing your round with interest, I think a lot of founders are like, oh, well, we'll do that so long as we get a term sheet that pushes our valuation up. And the answer is like, okay, but don't let that valuation creep up so high that you can't live up to those expectations, which I think Tim well articulated earlier in the session. So I think it has to be an honest conversation, but I do think that there's often your back is against the wall. You have to raise something. So in many cases, like I do think that often it's a full court press, and leaning on your insiders can be some form of a combination, right? For example, I'm actively in a process where we've had this kind of like petering momentum, but we have big name strategics who are taking us to second round of investment committees, and we have a number of folks who are very committed verbally to thinking about issuing terms. And we're like kind of discussing what those look like around milestones and tranches and kind of the nuances. That to me is like a good sign that there is real appetite for the round and the current state of traction. And this company and I are actively pushing forward on additional introductions with people who can potentially lead to make that round syndicate well, right? That's a good example of like, there's real momentum there. It just hasn't moved as quickly as we wanted it to, and so we're looking for the right catalyst.
Tim, anything you want to add?
Yeah, I think the way I often describe it, at least from the operator side, and where I think there's obviously a whole host of complexities that go into the VC piece, where the you could be having trouble fundraising as a VC at that point. You don't have enough exits or any of those things. There could be momentum shifts. But assuming like you're talking to groups that are ready to roll on this, like the way I think about it, the VC has really two big risks, right, in leading around or getting that prime term sheet. The first is stamping your name to something that either fails quickly or has like a bad reputational risk. The second is that you put out a term sheet and it gets hung out in market because you mispriced it. And then that's like also some reputational risk that goes with you along with the company as you kind of close it. And so when I think about it, back to like the question of like, is it truly stalled out? I'm basically looking at both of those buckets and I'm trying to say, do I have any tools in the toolkit where I can alleviate some of those constraints that could potentially free some of this up? So if you think about the stamping your name on something, that's really the milestones and the build up and like, what do I have left in my toolkit that will be coming up? That could be an inflection point here that could inspire it. The second part, though, is, building up the book behind it, which I think a lot of that work goes in early too. I'm a huge believer in radical transparency with the investor base. Like we do bi-monthly updates for everybody, and we kind of go through the good, the bad, and the ugly because, sometimes it's scary being that vulnerable, but it also builds the mental muscle that you can overcome those challenges because I think most investors are acutely aware that it looks like a sine curve as things are going, and that's the way things go. And so continuing to build a book or having a pre-strategy with the existing investor base really holds well. And this obviously is separate from seed is its own animal, but even this, some of it holds true as you deal with some of the angels in the early perspective or who can fill the book with if something's led. But like, how do I build certainty that things won't get challenged in the price? I think the other piece that too often can happen is like you go with the top end number of money that you're asking for, and then it causes reputational risk that you can't fill it. And that might be the number that you want to go, but I'm a huge proponent as well of like going to market with a range of what you're targeting to basically say, hey, look, we got to test the market, and it can be anything that you want to base it on. I typically index to like, look, we're targeting a dilution number. If the market says it's this much in valuation, then I'm going to take in this much capital. If I feel like there's momentum there, I'm going to take in more. And here are sort of the two different plans that I'm going to go after it. I think like that's also a tool to like, because there's always that challenging question where the VC goes to, what's your valuation expectations? And it's a not winning question because you either say something too low and they go great, or you say something too high and then they could walk away. And so you're really trying to frame it that you have some wiggle room in the process so that if things are slowing down, that you can still come out looking successful depending on how you positioned it.
Can we banter on that a little bit, Lisa, unless you have anything burning on momentum building? Because those like questions are really challenging, I think, when people are trying to move those numbers to invoke momentum. So you go out, Tim, with more of a range of what you're willing to raise, and you say, I'll fluctuate this based on the dilution I'm offered in the market. Have you seen that like backfire in any way? Like, have you seen investors approach your kind of and scrutinize your use of proceeds in a way that's like, show me what happens in this range?
No, no. Well, I will show them what happens in that range. So
Yeah.
I'll basically go to it and I'll say, look, the lower bound does this. My inclination is to raise towards the upper bound of what we're doing because, and like, even if I do it, this base case still needs to be true before I'm going to start releasing that capital anyway. And so what you're basically doing is starting to build the narrative and like how that proceeds and how you are a prudent operator and how you're going to structure all of those things. Now, the challenge for the founder and the operating side is what you don't want to do, but you might have to, back to like Leo terms, is you don't want to get overly locked in on like getting operating milestones for release of funds, because obviously that could make you feel like you've artificially got cash. And if you start to miss those things, they can pull them. So there's a bit of an art to it. But I wouldn't call it hiding the ball. I would basically say, look, if the market's soft or any of these things, we're going to build slower, and that's okay. And this is what building slower looks like. And it's still a compelling proposition where we're not going to burn more capital than we said we were going to.
Yeah. Heard. I've approached things similarly with like, hey, I'm not trying to confuse the market. So we're raising 35 million. I know exactly what I would do with 40 million, 45, and 50. And so if you, investor, believe in that growth story with me, I'm super open to discussing how a valuation range could make dilution within the expectations of our series of a typical Series B in order for us to get there. And here's the other tools I might even use to layer in the capital stack, like equipment financing, venture debt, et cetera, at those stages. More from like a use of proceeds basis than a dilution basis, but I appreciate what you're saying. And to answer a couple questions that have been percolating in the chat about specifically like timing of like when you open to when you get to term sheet around these conversations. You know, it's never a perfect science, but to Tim and Lisa, some of their earlier comments, like you're leading with value proposition and getting the hook far before you're deep in technical diligence. And you're meeting investors and having the get to know you conversations for months and for many conversations, and ideally in person so they know you're human and authentic, and you can be talking about, I'm not fundraising, but I am actively working through these things. Here's my proposed solution. What do you think about it? And those forms of communications can be just as powerful getting that investor ready to accelerate to term sheet by the time that you officially open a round. And the best case scenario is that building those relationships results in someone saying, don't open a round. I don't need to see a formal data room. Like, give me XYZ documents and like let me preempt something for you with a term sheet. That's one of the best positions that you could be in, most often at the earliest stage, because the later stages just require so much prep and synchronization across your data room. But Lisa, any commentary on that?
Yeah, what I'd add to this conversation is looking at if things have stalled or slowed down, you can step back and you may want to ask the question, am I talking to the right investors? You know, these investors, you know, do they even have dry powder, right? So investors will continue to take meetings with companies. Maybe they're only going to make one more investment, two more investments out of their fund, for instance, or maybe they're only making a few investments per year, but they're meeting, you know, hundreds of founders throughout the year, or they're getting pitches anyway from hundreds of founders throughout the year. So there's a question: do I have the right investors on my list? Are they investing the right amount for this round? You know, are we the right type of portfolio company for them? So there's a kind of assessment of the investor base that could happen if things are stalling. There could be is there investor fatigue? You know, are things moving? There's no real momentum. There's no real urgency. So they can just wait and see how you advance the business while you guys are talking or what have you. And there's no real need for them to close around quickly. No milestones that they're seeing hit or what have you. So can you create that momentum as we were talking about before? And then also prioritizing early, just developing those relationships where there can be the honest feedback, always searching for feedback, I'd say. And then also, so what needs to be true for you to invest, and what would be a deal killer? What are the things that we need to make sure that we address that early? Like, what about this deal are you concerned about? Or what are the risks that you see? And making sure that you're addressing those things. They're not unspoken, but you're actually talking about those things. And then they may give you feedback. And the feedback might be, we've slowed down because, here's the thing we're concerned about. And that'll give you an opportunity to address that concern. If you can, it might be over time. You might have to do some work, or maybe it's not even a real concern. You need to just communicate what they need to know. So those are just some things to add to it, the conversation.
I think maybe two things I would say to this. One is that it is really important to understand the psychology of investors when it comes to giving you feedback. Most of the investors who give you feedback are not giving you honest feedback. They're giving you filtered feedback that allows them to maintain optionality to invest in the company later. It allows them to save face. There's like lots of things that will happen. And people will also sometimes will tell you a reason that they're not investing that isn't actually the reason, right? The reason might be that they're just not excited about your company. But they're like, I don't want to tell you, I'm just not excited about your company. So they'll tell you something else. And sometimes founders will over-rotate on the feedback they get. And they will start making changes to their business model, to their deck, to their narrative, because of the feedback they're hearing from investors. And it's really, really important that you think critically about what you're hearing and understand where the person who's giving you the feedback is coming from. And like, obviously, if you talk to 100 investors and 100 investors give you the same feedback, they're probably right. But if every three you hear something like you just want to be really careful. And then the other thing I want to say is that the last thing you want is for the reason there's urgency in your round is that you are running out of money. That is not the position that you want to be in. So a lot of founders will wait too long to start their fundraise process or their debt conversations or whatever it is, the way that you're getting money. It is way better to raise early than it is to raise late. Now, obviously, if you don't have the progress or the milestones or the metrics to justify a raise in the current market, then maybe you can't go out and do a full raise. Maybe you have to do a bridge or an extension of your last round to get yourself there. But the less money you have in the bank when you raise, the more likely that people will take advantage of that. Because despite what VCs or any investor is going to tell you, like, they're not your friends. They might be friendly, but they're not your friends. This is capitalism. People are trying to make money. And if they can get a better terms because you're out of cash, they will. Because you're desperate. So don't be in that position. You know?
Can I just double click on the comment about feedback and advice? And one thing I want to say for me, I definitely am surrounded by so many advisors that I'm constantly asking for advice, feedback, suggestions. But in the end, you are the founder. You are the one that started this business. You know it more than everyone else. You have the context. So I say take advice freely, but decide what you're going to execute on, what you're going to implement, what you take, what you leave, what might be useful later or useful for someone else, what have you. So just always have that confidence that this is your vision, the thing that you built, you're bringing into the world. With that confidence, there's a lot of people that have a lot of expertise out there that have wisdom, listen to that wisdom, but also know that you know how to execute.
Super well said. And it's a bad look for investors to be giving you false feedback or to be giving you kind of no feedback, especially if they've gone deep in diligence. Like if I'm in the fundraising process, like I actually take note of that, right? Like the best venture investors out there are giving like 3 bulleted point like essays for kind of like what about the market they're concerned with. But to Dimitri's point about them trying to save face, keep optionality in the relationship, I actually think the same should go for founders. Like you should try to leave that relationship positive and have said like, hey, I acknowledge that feedback. Like, thanks so much for the candor. Here are the ways I'm gonna try to integrate that or think about that and like hope to keep the conversation going if and when this changes in the future. Because you kind of never know. And sometimes people do come back. Rare, lower probability, sure, but this also goes to like how you qualify the investors as you think about prep for the fundraise. Like I get into these conversations sometimes where people come in and they're like, help us finalize the round and build momentum, and we need to get the lead investor. And I'm like, great. So the person who could be your potential co-lead, like what's their average check size? Like what's their ownership target? What fund are they deploying out of? How much do they keep in reserves for you beyond this? And like, if you don't know the answers to those questions, you have not qualified your investors correctly in the same way that you should be qualifying every sales lead that you're going after and approaching that conversation pretty early on in the process of like, hey, could we have 30 minutes 20 minutes where I just ask you more about like what you've done in the portfolio with this same capital intensity profile, like what you're seeing from an ownership target perspective right now. All of that can make you come across as a founder running a fundraising process who intimately understands the needs of that investor and their return expectations over time.
So much good stuff. You guys, this is so good. Okay, as we finish up, I have kind of a last batch of questions. So one, and this is for everybody, what is a common fundraising mistake that experienced founders make? Not novices, but experienced founders. What's a common mistake you see? Who wants to go first?
I can go first. The one I would say is that corporate venture capital firms always take longer than you think they're going to in terms of participating in the round, especially if it starts layering on complexities with future partnerships with the business. I think it's one of those ones where every time you're like, oh, this is close, but then you realize there's like a ton more bureaucracy and process and everything else that goes into it. And so if you're banking on that to be the thing that fills the round, or the thing that really tips it, like you need to be doing that way, way in advance, because like even as we've tried to bring them into processes at the same timeline we're going, it's really hard to keep them aligned. And if you're got a lead that's not willing to do two closes or any of those things, it could actually be a risk on the round, kind of over indexing to bringing them in.
What I would say is maybe that the next round is going to be like the last. That could be one where you're dealing with different types of investors. They look for different things. You're at a different stage of the business, a different group of investors you want to talk to. So I think that's something that could be a mistake that founders would make, experienced founders.
Hannah, what you got?
Mine's quick and also on process. The complexity of synchronizing your materials at the later stages becomes exponentially harder. If you are
Mm,
raising off balance sheet project finance, any form of debt blended in with your, large Series B or Series C, all of a sudden, intro deck to long form decks to market overviews to pipelines to TEAs to project models to financial models, all of those need to be speaking together to be telling the same story. And at the later stages, and even for the most experienced founders, that task just becomes inherently more complex, but also more important. And therefore, the preparation timeline of what you're doing internally with data rooms and behind the scenes, and having kind of like your run of show of like who's going to step in and deliver on the model deep dive versus, and like I'm talking like auditing the formula in cell AB127, right? Like that task just gets harder. So that happens at the later stages and people don't prep for that.
I'm going to add one, which is I think that that people often assume that the more traction you have, the easier it is to raise. And counterintuitively, that is not the case. And there's like a long running joke about this in Silicon Valley, the show, but also this comes up a lot where it's like, oh, as soon as you're pre-revenue, you can tell whatever story you want, but as soon as you have revenue, you get valued on a valuation multiple of revenue, and everything changes. Um, and so I think that like the mistake that people make is they will often think that the metrics speak for themselves, and it's still as much a narrative game. It's still as much a storytelling game. Um, and it often even makes it harder. Like I don't know, maybe this is just my experience, but raising pre-seed with a pitch deck and a financial model when we did it was way easier than raising our seed round, even though we had grown 5x year over year the year before that. It like really didn't matter. So that's a mistake we often see. Um, Lisa, I have a question for you. And this is a very personal question for me because it applies to me also. But I think every founder in the room who has raised money before has probably had a raise that like almost broke them. And it's like it like takes a lot, like a very big emotional and physical and psychological toll. Um, did you have a moment like that? And what was it like and what did it teach you? Like, and I'm happy to also share mine if it would be helpful, but I'm curious to hear your perspective on it.
I mean, my first answer is that there are many moments like that, right? But
Every
but
raise.
seriously, I think one of the things that I learned maybe early, I think initially I was taking my technical, my co-founder and taking other people to meetings with me, and just how much of a toll that was taking really on other people who aren't used to having to have so many meetings, and they're all not successful, right? They're used to success and everything. They are, I'd say, successful even when you get a no. A fast no is better than other things. So I think I had to learn early on just that I needed to protect the team from the investment process, from the fundraising process, is what I would say,
Mm,
and know when to bring them in. Like kind of have pretty much a lot of the early meetings without them, and have the finance lead in there, of course, but the rest of the team, bring them in only after we've kind of qualified, we've kind of clicked through several layers, and we know that this is, these are the final few investors that we're in deep diligence with, and they have the highest likelihood of investing. I think that was more like how to protect the team. That was an important early lesson for me.
I think one thing that I'll share about, so when we did our pre-seed raise, I approached it like a sprint and not a marathon in a way that was really problematic. I think we had really good momentum initially. I think we closed like $1 million in our pre-seed in the first month of fundraising. And it was just like, I was like, oh man, in a month, I'll close the rest. Our target was like 2 million. And I still remember that was like July. And in between August and September, I think I had like 100 new investor meetings. And there would be days where I would have 5 in a row with like no breaks. I would just go. And it was very, very emotionally taxing. It was very like mentally taxing. Not only because almost all of those conversations ended with people telling me that I had a terrible idea that was never going to be successful, but also because in the midst of all of that, I still had like a business to build with my co-founders. Um, and the problem is that if you don't sort of like give yourself the space to protect yourself as a person, give yourself time to rest, to breathe, to reflect, to like go for a walk or work out or whatever you need to do, it also starts to show in those conversations. And investors, you're no longer showing up as the best version of yourself. You're showing up as the like worn out, burnt out fundraiser. Nobody wants to back that founder. And for me, the thing that actually changed the tone of the raise, we like got through September and there were no new commitments. And I took like a 1 week break, and then I started to have conversations again. And I made sure that I only had like two or three new conversations, maybe 3 days a week, so that I could still maintain momentum, but I wasn't as like burnt out. And immediately I started to feel better. I started to be more confident. And I started to get more traction. And I think that like sometimes we forget in the interest of maintaining urgency or running a tight process or being fast, like you still actually have to bake in time for yourself to be okay, because you won't be. I don't know, Hannah, Tim, you guys want to add anything?
No, I think you hit the nail on the head. I think, and it's funny, if you sit in the finance function, you often forget, and the founders are pulled into this because of raising, but like you're as much of a sales member as anybody. And not just in the context that everybody's a salesperson at the company, but because you have to get very comfortable with being rejected. And that's like a thing that you like, the same way a salesperson picks up the phone and just keeps calling and calling and calling, like they kind of build the mental models and how to manage all of those things. I think it's important to figure out the strategies on how to deal with those things. I think it's also back to like the ups and downs and things like that on the company. It goes beyond fundraising, right? Like there's just going to be stuff that happens, and like you need to figure out how to maintain sort of even keel throughout all of it, to say, look, one of the things I often tell people, I'm like, there's going to be, at the founder level, the C-suite level, there's going to be like 10 existential crises pretty much every week. And like you'll find out that 7 or 8 of them will probably go away on their own. Like the team will just figure it out, and like they raised it like it was the like sky was falling, and it wasn't. And so you need to learn how to figure out how to like manage through those. And then the 2 that you've got, like how are we going to tactically approach that, and are they really that dire? And then what sort of the game plan so that you feel comfortable on how you're actually managing through it.
Man, it's a privilege to be a conversation. I'm so impressed with like all 3 of you, and obviously you've all built that muscle so durably and have done it really thoughtfully, managing your teams as well. one thing that struck me over the course of this conversation is that there's a real inflection point in fundraising where you go from pitching and explaining and catching someone up to speed to partnering, where all of a sudden they're poking meaningful holes in the business or roadblocks that you yourself are also staying up at night about. And some of those can be very personal, which is like, hey, your co-founder is not the long-term CTO of this business. Your co-founder is not the long-term CEO of this business. It's like it can be really prescient feedback. And in some ways, like that's the fundraising process going well. It's like all of a sudden you've got this partner that could, seize those warts and bumps and like the gaps still to come and understands like, but that's solvable and tractable and we could do that together. And like you're not seeing this yet, but I know how to look around those corners. And like the fundraiser, not Hannah personally, that's like such a privilege to get to in that part of the process, but it's also like the most raw. And I would say in a lot of cases, like I do sometimes see like ego tempt us to lean away from that type of relationship with an investor, but actually the best thing to do is like actually, that's the type of investor you want to work with who has the candor and the foresight to help realize those things. Um, so different tact, like outside of managing yourself and your team and all of those roller coasters in the fundraising process, there's also the how do you get to that level of candor, success, partnership with funders themselves. Hopefully so that you build someone. I mean, this is a marriage. When you're raising capital, you are getting married to someone on the cap table and they are going to have governance rights and board seats and big influence and your reputations are tied together. And that's a great thing in so many ways. So making sure you're signing up with the right partners, I would say, is always a real element of the fundraising process.
I think this is a perfect moment to go to our last round robin question because we're out of time. And I'm going to maybe answer the question first. I'm going to cheat a little as moderator. Usually I don't do that, but I'm going to do it today. So what is something that you've had to unlearn about fundraising as you've done it more and more? Like what is a thing that maybe it worked early on, but it's a bad habit now, like talk to me about that. And I think to Hannah's point, the thing I've had to unlearn or relearn is that there is one big difference between sales and fundraising is that in fundraising, being tactful in your vulnerability and candor about problems can be an incredible advantage. Like when you're selling, you want to put the best version of your product. You're not going to be talking about where your team is deficient. You're not going to be talking about where the widget fails. Right? You're going to be like, we're the best at this thing. But when you're fundraising, if all you do is say we're the best, you don't talk about any of the things that are hard, people just won't believe you as much. But if you show up and you're like, we're good operators, we're thoughtful, we understand where the issues lie. Now, obviously, you can overdo it. And you can freak people out with the problems you're talking about. But there are moments where you can introduce things that also give people the opportunity to be that partner and to say, oh, actually, we can help you solve this. And we're excited about this problem. We have experience solving this problem. And I think that has been something that I've had to unlearn. And it's interesting because I think between the pre-seed round and the seed round, that dynamic was different. Because when you're pre-seed, you don't really know anything about the problems you're going to have. And so like, it's okay to be blue sky and excited. But then over time, like the more mature you are, the more people trust you as an operator. Okay, let's go Lisa, Tim, then Hannah to close this out.
Yeah, I'd say for me, it is the mindset shift from it being an ask to an invitation. So it being something I need from you to I'm inviting you to be a part of this journey. And, here's the opportunity, here's the return that we're creating for those that are our partners, and really thinking about it more as a partnership and humanizing it a lot more.
I like that.
Yeah, I'm probably in the same vein. I think humility is absolutely essential. And right or wrong, sometimes like when I meet new startups and if a founder's like overly confident in any of their delivery, I'm like immediately suspicious in terms of what's going on. Like, so to that point of like understanding and identifying what those challenges are, and saying, here's how I'm going to attack it, right? Like, and I saw some stuff on like hard tech is a great example of this. I saw some questions like, how do you raise money if you're a hard tech, it's going to be capital intensive or any of those types of things, and the numbers just aren't there when there's step functions. Like, I'm a huge fan of like waterfall charts and saying these are the 5 levers that I'm going to pull to get from point A to point B. Set aside like there's all these different line items, everything that's going to move, but let me contextualize exactly the 5 things I'm going to do. Here are the 3 that I have the most confidence with. Here are the 2 that I think might be a challenge. Will the bars look exactly the same that I just put on here? Absolutely not. But the order of magnitude is probably right. And there'll be some pleasant surprises along the way. There'll be some things that don't pan out. And like what I'm giving you is actually the vernacular to come along the journey with me, because from January to February, my gap financials aren't going to really change. But I might have had a breakthrough in terms of something where now I've moved from truck to rail car in how I'm transiting something, which is going to have efficiency stuff that's going to percolate through. And that's that first bar. And we've seen the first batch go through and we've proven that out and we feel good. So I think it is like, it's really owning those challenges and framing it that way versus just dollars and cents. And like, there's a sense of inevitability, but like really like, here's why I have confidence in where the risks are.
Love that. I feel like an inadequate wrap to such a great conversation, but in the spirit of 1 minute left, I think the unlearning perhaps that I've had, oh my gosh, the thought just completely left my mind. The partners you bring along as funders, I think that there's so much uncertainty that I think that the unlearning I've done is a bit of like, you will do plan A, B, and C, and they will all be wrong. So you will adapt along the way. And in fact, the way you adapt, the people you adapt with are partners, the funders, as well as your team in the process. I think that's the most important part than having like the perfect data room, the perfect pitch deck, the perfect storytelling piece.
This is a thread that I think has come up a lot in this dialogue today, and actually a great way to close this out is that in many ways, the best fundraisers are the best communicators. They set expectations, they communicate about which expectations they hit, they communicate about which ones they missed and why. To Tim's point, they have a plan for the things they missed, how they're going to fix it. Like, your communication skills are such a critical aspect of being a good operator, and being a good operator is what investors want about. And so, thank you so much, Lisa, Tim, Hannah, for sharing your wisdom with us today. This was awesome. We will be posting the recording and the notes in the next week or 2. We'll send them out through Luma. We'll put them on LinkedIn. We will be announcing our March event on Monday, I think. And yeah, on Monday, because I think it's now balls in my court. And then we're going to keep doing these every month. So, sign up, come rejoin us, and excited to see you all back in a few weeks. Take care, y'all. Thank you.
Thanks, everyone.